Hey guys, and welcome to another video. Today we are going to look at AMD, and AMD is a chip manufacturer competing with Intel and NVIDIA, and it's a high PE stock, but I still own AMD at a lower price of around 70 to 80, I think. So let's first look at the graph. It's gone down a bit. The best entry point would be somewhere down here because it's gone up already pretty far, but let's see if it's still undervalued. In comparison to NVIDIA, AMD doesn't really belong to the AI sector. It's only a chip and GPU and CPU manufacturer mainly. But now let's look at the numbers. So first we have growing revenue, and we have positive net income, and it's also grown a bit. We have more shares every year, which isn't that nice. We don't want to see more shares every year, but I think they have stopped recently selling more shares. Yeah, it has stayed the same since quarter 2 2022, since it's gone down, since the stock has gone down. So if they stop, I will sell my position if they start selling shares again, probably, because I don't want to own a company which sells shares and decreases my ownership of the company. But until now they have the same number of shares, so I'll keep the company for a bit. Then we will look at the total debt. They also have cash, I think. Yeah, they have 2 billion, almost 3 billion in cash, and they have total debt of of 2 billion, which isn't that high compared to their earnings, which are 1 billion, so they don't have to pay that much debt. Their cash flow from operating activities has increased every year, and their free cash flow has also increased every year. And I think their free cash flow is higher than the net income, which is a good thing. You want to see that. They don't pay dividends, and they don't buy back shares at the moment. But I think they have a buyback plan for shares, so that could be nice. But the shares are still a bit overvalued if you look at it that way. So I don't recommend them to buy back shares, but to pay out the dividend instead. But now let's put in the numbers for our calculation. AMD, revenue of 23 billion. Revenue growth of, let's say, 7%, goes up to 45 billion. That's still low, but we'll keep that for the moment. Cash flow margin, net profit margin is, let's say, 5%, maybe 5%. For the lowest assumption, we'll go with 3%, which would be really low, and price to earnings ratio for the lowest would be 15, which is almost every year, which has been higher almost every year, 200, 55, 150, and so on. But we'll put 15 for the lowest assumption. Maybe even 10. Let's put 10. That's the absolute lowest assumption. And in that case, AMD would absolutely go down to $2 per share. But let's put in some more reasonable assumptions. Price to earnings 15 would increase to $3. Maybe price to earnings of 20 is reasonable. Profit margin of 5% would be more reasonable, would make the stock price go up to 7%, which isn't that nice either. So let's look at our revenue growth. We could increase our revenue growth to, let's say it goes up to, we could argue that AMD's revenue goes up to Intel's revenue, which would be 63 billion, maybe a bit higher than that. So let's put in 11% revenue growth. Yeah, maybe 12%. That would be already really high. In that case, you would have a stock price of $12 per share, which is still not very nice. and we could put in a higher profit margin. Like for example, we look at Intel's profit margin. Intel has a higher profit margin of around 20%, so we can put in 20% for that, but that's high assumptions, and in that case you would have to buy it at $50 per share, which it hasn't even touched. But these are assumptions with very low PE. If you put 25 PE, the stock price would go to 62. So in the highest assumptions case, which would be this case with these numbers probably, with a reasonable price to earnings, it would be a good buying price. $62 would be a good buying price, but at the current price it would go up 2 times. So you would have to think if you want to own a company. It's a bit risky, but it's definitely a better buy than NVIDIA or other high PE companies like Tesla, because NVIDIA has much room to grow. So if you really want to have a growth company, you could look at AMD, for example, because if we put in a higher PE, which I wouldn't really recommend, but if we put in a 50 PE, it would obviously make a huge profit. But let's say reasonable 25 price to earnings. That could also be a margin of safety, you could say, because the stock has such a low PE compared to its average PE over the last few years. So $62 would be a good price to buy with these assumptions. Now let's look at our cash flow valuation model. So to be honest, I've bought AMD with wrong numbers, but I still think I don't want to sell it, because at the price I bought it at, it's a decent investment, let's say. But at the current price, it's a bit high. If you think it will grow really much, maybe get higher revenue than Intel, or even higher than, or even more revenue of around 100 billion, which would be really high, you could buy it at the current price. But like I said, it's a growth stock, so you would really need to be bullish on the growth AMD has. So financial bankers say the cash flow will grow around 9% every year. Let's put in 8% in this case, 8%. Growth rates for the next few years 4%. Discount rate 10. Terminal value 15. Year 0 free cash flow was 3 billion, I think. 3 billion. Let's put in 3,100. Stock-based compensation would be probably really high. No, 1 billion. Okay, I have 1/3 of the free cash flow. Net cash, net debt would be 3 billion. And shares outstanding 1.5 billion. Which would make the stock be overvalued by 400%, because the cash flow doesn't really, with these low growth assumptions, the stock isn't really a good investment with this model. The intrinsic value per share would be $21, which is far off the price right now. But we could also put in higher growth assumptions, because these growth assumptions would make the free cash flow less stock-based compensation go only up to around 4 billion, and it's at 3 billion right now, or 2 billion right now. So let's put in maybe 20%, 10%, which would make it go up to 8 billion. And if we take our revenue of 60 billion from Intel, which AMD could achieve, and put in our current free cash flow margin, which is, let me look, price to free cash flow, is it even on this website? Yeah, we can just calculate the free cash flow margin by looking at the revenue, in this case 23 billion divided through 3 billion of free cash flow would equal to 13% cash flow margin, which would be higher than the profit margin. And now let's take 60 billion times our, we would have 7 billion of free cash flow in this case. So let's go for around 7 billion. 15%. Yeah, maybe like that. These would be reasonable numbers if our revenue would go up to 60 billion in that case. So it's still overvalued by a lot. Your intrinsic value would be, so your buying price would be $32. So if you like the free cash flow model, AMD isn't a stock for you. It's for people who want high growth stock, like I already said. So if you thought about buying NVIDIA, maybe look at buying AMD instead. And yeah, that's it for today. If you liked the video, give it a like, and bye.